Assalamu alaikum. Welcome to lecture 38 of SBR, which is IFRS 16, Leases. Now, this standard also has a very high chance of coming in your SBR exam like IFRS 15, the previous lecture. Okay, here we are going to go through what is the definition of leases, how do you identify a lease in a contract, what is lease accounting, lazy accounting, lessor accounting, sale and lease back. Okay, now before we start the accounting part, you need to know some terms. It's not going to come in the exam, but you need to know it. Okay, for your understanding of the subject. Lease. See, when we did IFRS 15, what was IFRS 15? It was simply revenue from contracts with customer, right? A contract to give a service or a good to a customer. But you are exchanging it. You are selling the goods or services to the customer entirely. Once the customer has the control of that good or service, you recognize a revenue according to IFRS 15. In IFRS 16, it's the same thing. Again, it's a contract. But this time, the difference is you are not giving the control of the asset to the customer. You are allowing your customer to use your asset for a certain period of time in exchange for a consideration. That's the meaning of lease. So lease is nothing but it's a contract. It's a contract to say that your customer can use your asset for a certain period of time, let's say for 3 years, 4 years, 20 years. There's a lease term, right? Whatever it is. For a certain number of a year, they'll be using your asset, but while they're using your asset, they'll be paying you in exchange for it, consideration. So you are receiving consideration as a lessor, and the leasee, the person who has taken the lease, they are going to pay you consideration. They are going to use your asset. They are not going to control the asset, but they're going to use it. They're not going to have the ownership of that asset. Okay, that's the meaning of lease. It's a contract basically. Now there are two parties. Okay, like if any contract, for a contract to take place, there should be two people. It could be more than two also, but two. One is known as lessor. Who is a lessor? It's like employer and employee. Employer is the one who but employer is the one who hires the employee. Okay, employee is accountable to the employer. So here also we have two. One is known as lessor. Lessor is the entity that gives that right of use asset to another entity. And in exchange, lessor receives consideration. And lessee is the second person. The entity who's receiving, who is obtaining this use of asset, right of use asset, and paying consideration to the lessor. So I hope now you can visualize this whole lessor and lessee thing. Do not get confused with this two. Okay. Next term is right of use asset. Right of use asset means is the lessee's right to use an underlying asset over the lease term. Lease term could be it will be given to you in the exam. It could be for a few years, like 2 to 3 years, or it could be for 5 to 10 years or more than that, 20, 30, 40 years also. Okay, there is no fixed term for lease term. It could be any number of years. Now you need to identify a lease because there are so many contracts, but not all the contracts have lease in it. You need to identify a lease in the contract. That's what IFRS 16 says. Okay, so IFRS 16 says lessees have to recognize an asset and liability for all the leases. Any lease you go into, who is recognizing? The lessee, not the lessor, because it's like lessor is the one who is selling and lessee is buying. It's in, right? You can take it like that. So that's why lessee has to recognize that asset and liability. Why asset? Because he is using that asset for a certain period of time. Why liability? Because he has to pay consideration to the lessor. Okay, but there's an exception to it. Unless they are short term or of minimal value. Short term means there are short term leases, let's say for 1 year or 6 months, you don't have to record it. Okay, I think short term is less than 1 year. You don't have to recognize an asset and liability. In that condition, lessee does not recognize an asset and liability. So they are exempted from it. And of a minimal value. Minimal value means when the first time you are buying that asset or using that asset, what is the value? Okay, if that value is not a huge amount, okay, then you do not recognize lease. For example, you might say I've taken a lease for using phones or for stationery items. Stationery items and all are of a minimal value, right? When you buy it for the first time also, they're very cheap, so you do not recognize a lease for it. Okay, that is the meaning of minimal value. So but let's say you are leasing an aircraft. Yes, aircraft, when you buy it for the first time also, the value is huge, so you have to recognize a lease. It does not come under minimal value. Okay, same for any buildings or machineries that you have taken on leases. Okay, so if the lease is for short term or minimal value, you do not recognize an asset or a liability. Otherwise, other than this two, all the leases you need to recognize. Lessee needs to recognize an asset and a liability. Okay, and your IFRS 16 is based on this only. How Lessee is going to recognize? You have to do calculations. We'll do forward, right? As we go along, we are going to do questions. How they are going to recognize this asset and liability? Because in your SBR, this is what is tested. How Lessee is going to recognize that asset and liability? Your working is that only. Okay, now, so there could be two types of contract: a contract for service or contract to lease. Okay, our focus is only on the lease part, not the service. Contract for service, we finished it in IFRS 15 already. Okay, if you haven't watched my IFRS 15, you can go back and check that as well, right? If you have, if your knowledge on IFRS 15 is not very clear, you know, like if you want to clear it. Next, a contract contains a lease if it conveys. How can you say a contract has a lease? If it conveys the right to control the use of an identified asset for a period in exchange for consideration. Okay, in the it should be written there that they are giving this asset for a certain period of time in exchange for consideration. Now, customer controls the asset's use if it has two things. Number one, all the benefits should go to the customer. If it goes, then customer is the one who is controlling the asset's use, how the asset will be used. Next, right to direct the use. They are going to say how assets will be used. If customer has these two things, then you can say customer is the one who is controlling the asset's use, the use of that asset. Now, the right to direct, please understand this part. This part is little tricky. Okay, the right to direct the use of an asset can still exist if the lessor puts restrictions on its use within the contract. Let's say lessor is saying that you can only use this asset in certain countries. Beyond this country, you cannot use it, or you are capping maximum mileage of a vehicle. So what's happening here? Still, the lessee can have a say on directing its use, how the asset will be used. Here, what's happening is that is this restrictions only define the scope of the lessee's right of use. Scope, it's just reducing the scope. Okay, rather than using it in all the country, you can now only use in certain country. Only the scope is reduced, but still lessee can have direct the use of the asset. Okay, so it's just defining the scope of the lessee's right of use rather than preventing them from directing use. It's not preventing them, it's just defining the scope, that this is the scope, and in this scope lessees can say or can use the asset any way they want. Now, IFRS 16 says that a customer does not have right to use the asset if supplier can substitute that asset for an alternative use. Okay, customer does not have the right to use an identified asset if supplier has alternative use for that asset. Okay, if they have the practical ability to substitute that asset, and also doing so will economically benefit the lessor, then lessee does not have the right to use an identified asset. Okay, now let's do two questions before we move on to the accounting part. Test understanding 1, coffee bean. So there are two questions, and in these two questions The question is the same. Does the contract contain a lease? Okay, so we'll read first one. First one is about and space in the airport. Okay, it's the contract is about to use some space in the airport. That also some space. Okay, to sell their product for 3 years. Okay, Coffee Bean owns this portable device. Okay, Coffee Bean is the person who enters into a contract with an airport operator. Okay, now the contract stipulates the amount of space and states that space may be located at any one of the several departure within the airport. The airport operator can even change the location of the space allocated to Coffee Bean at any time during the period of use, and the cost of doing this is minimal. Okay, that means there are many areas in airport that are suitable for this. Does this contract a lease? If your answer is yes, okay, reading everything, that means you still didn't have the understanding of IFRS 16. It's poor. You need to revisit the previous slide. If your answer is no, yes, you have understood. It's correct. No is the answer. It's not a lease. The contract does not contain a lease, but you have to give reasons. Just saying it does not contain a lease is not enough. Why it does not contain a lease? Okay, we'll see the answer. I've pasted the answer, but my main motive is not to copy paste this answer and memorize it. No, you need to understand the points behind the reasons. So first you start by defining by saying no, they do not contain a lease because there is no identified asset. You see, did they say which asset? No, they just said some space. So the contract is for space in the airport. Now it could be any space. They didn't say this space only. So number one reason, okay, one reason, no space, no identified asset. I will highlight it, the points for you. No identified asset. After saying no identified asset, you need to link it to the case study given to you. The case study talked about space in the airport. So you also have to write space in the airport in your answer. It's not another point. It's just the explanation of the first point. Okay. And the biggest reason is they have the right to substitute. The airport operator has the practical right to substitute this space. Now 2 points. This is from the case study. You have to link it. Okay. They told that there are many areas available. This is from the case study you have to pick. Okay. One is no identifiable asset. Second reason is this substitution is the number 2 reason. So 2 reasons. And substitution you can explain further from the case study. One, they told that there are many areas in the airport that can meet this contract terms. Okay. And also it is economically beneficial for the air operator to switch also. Why? Because they told the cost are minimal, isn't it? So they can easily substitute it. Okay, so it's not a lease. Now 2 is the same question. Does the contract contain a lease? We'll read. So here AFG enters into a contract with a Splash to use a specified ship for a 5-year period. Can you see the difference between the first one and this one? Here there is an identified asset. Specified ship they told. Identified asset has been identified. Very important for the lease. And it has no substitution rights. Number 2 reason. All this looks like it's a lease, but do not be too quick to judge. Okay. You have to consider all the facts and then look. No substitution rights. Okay. During the contract, AFG will decide what cargo, when the ship will sail, which port it will be sailed. So AFG, the one who is the lessee, okay, the lessee decides or directs the use of asset, how it will be sold, when it will be sold. All this decision lies with the lessee, which is AFG in this case. However, the contract puts some restrictions. The scope. What is it? That they cannot carry any dangerous material in the cargo. Okay. That is, the scoop is reduced. Okay. Now, Splash is the lessor. They operate and maintain the ship. They are responsible for the safety of the passage of the cargo. Okay, AFG is prohibited from hiring another operator for the ship and from operating the ship itself during the term of the contract. Does this contain a lease? Answer is yes. It contains a lease. Like the previous one, you gave reasons why no, now why yes. All these 3 points that I've told here. This is how they've explained. Okay. Identified asset is there. What is that identified asset? Specific ship for 5 years. Cannot substitute. That specific ship you cannot substitute for an alternative. Now, from the case study, we'll give points. Okay. Also, they have a right to control. 3 points. 1, 2, 3. AFG has the right to control the use of ship. Okay. Number 1 is all the benefits. See, the right to obtain substantially all of the economic benefits goes to the lessee. Okay. Second, they can even use a direct of use. You see, they told that where the ship will sail, at what cargo it will sell, decides where it will. All these are decided by AFG. AFG, sorry. So they're dieting the use. Even though there are some limitations, some scope is there in the contract. It says you cannot carry hazard, dangerous product in the cargo and all. But other than that, the decision still is with the AFG. They make the decision about how and for what purpose the ship is used. So that makes it a lease. Okay. Even though you can say that operation and maintenance is with Splash, it does not prevent them from directing how and for what purpose the ship will be used. It is still in the hand of AFG. Therefore, the above contract contains a lease. So now, after identifying a lease, we are moving on to lessee accounting first, then lessor accounting. Lessor accounting is not difficult. It's easier compared to lessee accounting because most of the major work is in this part. So I'm going through it slowly and you need to pick up the important points from this lessee accounting. Okay. So lessee is the one who will recognize a liability and a right of use asset. It's an asset. Okay. A right of use because you have the right to use that asset. That's why it's known as right of use asset. Okay. This is at the commencement of the lease. When the lease is commenced, it starts. Okay. Now, according to your conceptual framework's definition of an asset, right of use asset meets that definition of that asset. Why? Because lessee is going to get the benefit of that asset during the lease term. Because lessee can decide how the asset will be used. So they are the one who is going to get the benefit of using that asset during the lease term. That means benefit goes to the lessee. So it's an asset. Even the conceptual framework's definition of an asset says the same thing. Whoever has the benefit, they need to recognize an asset. So it's the same thing. Same with the liability. It is inconsistent with the lease liability is inconsistent with the conceptual framework's definition of liability. How? Lessee has an obligation to transfer a consideration to lessor in exchange for using that asset. Now, initial measurement. There are two things. One is subsequent, one is initial. Initially, lease liability will be recognized at present value of the lease payment. Why present value? Because you often paid at the end of the lease, let's say. Okay. But today you need to know the value in today's term because you have to recognize it today when you enter the lease, even though the payment might be done later. So initially you measure the present value of the lease payment that have not yet been paid. This is the starting point. Next, IFRS 16 says these are the lease payments. Number 1, fixed payment. Number 2, variable payment. Variable payment, it varies. It depends on some rate during the lease commencement date. In your exam, they will give you all this if there is so. They might give you just 1 or 2 payments, or sometimes with fixed they will give you other payments also. So you have to look carefully for those things. Third is amounts expected to be payable under residual value guarantees. What is this residual value guarantee? It will be explained in the next slide. Okay, so just keep it aside. Then option to purchase the asset that are reasonably certain to be exercised. That means that option you are going to exercise. How? By purchasing the asset. At the end of the lease term, you are going to purchase the asset. So any payment you make to purchase that asset is also included in that lease payment. Okay. Only if option is reasonably certain to be exercised. Otherwise, you don't take it in the payment. So these are the 4 lease payment. Remember again, fixed payment, variable payment, residual value guarantee payment, and payment from option to purchase the asset. Next, the last type of payment is termination payment. Any termination payment are also included in lease payment. That means you have to add all these 5. Okay, if the lease term reflects the expectation that this will be incurred, if in the lease term they say that they're expecting the certain situation might come where they might be terminated the lease, so that termination penalty needs to be paid if any of the one party is terminating the contract. Now moving on, residual value guarantee. Residual value guarantee means, okay, it's a promise. Okay, lessee is promising the lessor, okay, that at the end of the lease term the underlying asset will not be worth less than a specified amount. The value will not go down below a specified amount. It's a promise from lessee to the lessor. That is it's like a guarantee. You're guaranteeing it. Okay, residual value at the end of the lease term of the underlying asset. Now, what about the discount rate? Because you have to find the present value of lease payment. Obviously, you need a discount rate. So, which discount rate should you use? This discount rate is often there in their contract. Okay, but if it's not there, you cannot determine, then you have to use the rate that you use to borrow funds to purchase a similar asset. Okay, let's say if you're buying a machinery under a lease, you don't know the discount rate, but if that similar machine you have bought it from some third party, you know what is the borrowing rate. That rate you can use as a discount rate for lease. Now, right of use asset. So we are done with lease liability. After that comes right of use asset. This is initially measured at cost. Okay, and what includes right of use asset? It includes these things. Number one, it is the same as the lease liability. The initial measurement of the lease liability is your asset. Obviously, whatever you have to pay is what you are using. Okay, so the amount of initial measurement of lease liability. This is the starting point for right of use asset. Next, you add any lease payment made at or before the commencement date. Third, any initial direct cost, you add it. That means these costs are capitalized. Okay, they are not taken as an expense, rather direct cost and all are capitalized. They are added with the value of the asset. Then we have any estimated cost of removing or dismantling the underlying asset according to the condition of the lease. That also you add. Okay. Next is the lease term. Okay. So to calculate the initial value of a liability and the right of use asset, lessee must consider the length of the lease term. IFRS 16 says that the lease term has these things. Number one, to say that this comes under lease term, non-cancelable period. You should have a period where you cannot cancel the lease. Let's say it's 5 years. Okay, during this 5 year, no one can cancel. Then we have periods covered by an option to extend that lease. Sometimes it happens that you have 5-year lease, you have an option to extend the lease up to 2 years more. So that 2 years you are going to add with the 5-year depends on how certain you are of exercising that option. If you are very certain, you add 5 plus 2 becomes 7. Then your lease term is 7 years. Third, periods covered by an option to terminate the lease if reasonably certain not to be exercised. Okay. So this also comes. Period to terminate the lease. Then you have to reduce it from the lease term. Then, so before we move on to the subsequent measurement, till now it was initial measurement. Before we go to subsequent measurement, let us do 2 questions on initial measurement. Test your understanding. 3. Dynamic. Here, it's a good question because it's calculation. You calculate initial carrying amount of lease liability as well as right of use asset. And you need to provide double entries as well. Okay. 3 things are required. So first we'll see, okay, this is a 2-year lease for a lorry. They have an option to expand for a further year. Okay. And it is reasonably certain to exercise this option. Lorry has a useful life of, this is not often, it's of 10 years. Okay. 10. Lease payments are 10,000. initial per year for the initial term, and 15,000 for option period. Okay, all these are per year. Even all payments are due at the end of the year. To obtain the lease, the direct cost was 3,000. Out of this 1,000 was immediately reimbursed by the lessor. That means lessor has paid this. Okay. They couldn't find the discount rate, but they have used the borrowing rate of 5%. Dynamics borrowing rate of 5%. So everything is given. You just need to find out. So we'll start with always start with the lease liability. Okay, because you need that lease liability for your right of use asset. So always the starting point is lease liability, not the right of use asset. So let's do that. If you understood this question of calculating lease liability and right of use asset, you understood everything. You understood the whole IFRS 16, I would say. At least 70% you have understood. Okay, then you have nothing to worry, because that's the difficult part. So here, okay, you see here they have 2 years. They have an option to expend 1 year more, and they are going to exercise these options reasonably certain. So 2 plus 1, it becomes 3. So now they have a lease of 3 years. 3 years is the lease term. I'm noting down this for you, since this is the first question. Okay, why 3 years? Because they are reasonably certain that option will be exercised. Now for how many years? It's for 3 years. So you need to calculate for 3 years. Date, you can do this in your Excel. Okay, 31st December 2001, 31st December 2002, 31st December 2003. Now comes your cash flow in dollar. So now they told 10,000. First they told 10,000 without the option. Option 15,000 comes in the third year. So it's 10,000, 10,000 and 15,000, because third year is the option. Discount rate is 5%. Okay, so it will be 1 divided by 1.05, 1 divided by 1.05 to the power 2, 1 divided by 1.05 to the power 3. Okay, see this thing, okay, you can get it from the table also if you are doing it in Excel in your SBR worksheet, right? Practice ACCA practice platform. If you are doing it, you will get it from the table also. You can use it, or you can do it like this. In Excel, if you put it, you will get it. Then present value. Basically, you just multiply your cash flow with the discount rate. So here it's 9524. Do this on your own and check, are you getting this figure or not? Okay, you should be able to do it on your own. Once you see this, add, it's 31,552. So this is your lease liability, 31. Once this is done, we are coming to the right of use asset. Okay, so right of use asset, this is how you do. These are the formula. Okay, you need to memorize it. Initial liability value first. So initial liability is just now we have done it, 31,552. It is this. After that, direct cost you add. They told direct cost was 3,000. Anything reimbursed by the lessor to the lessee needs to be deducted reimbursement. They have reimbursed 1,000. So you add up, it becomes 33,552. Okay, so we are done. Now double entry. If the question asks for double entries, you do. Otherwise, if you don't do also, it's fine. But mostly in IFRS 16, they ask double entries. So be careful, okay? Right of use asset is a debit entry. Obviously, it's an asset. Like any asset, even right of use asset is an asset. Treat it like an asset. You cannot have a credit balance here. So it's debit how much? 31,552. You credit your lease liability. 31,552. Then this one was for the first one. Now for the direct cost. What you did? Debit. This is debit. This is credit. This is debit. Right of use asset, again you debited. Why? For the direct cost. You have added this direct cost. 3,000. Where did you credit? Cash. Because this cost will go from cash. Then you have reimbursed it. That means you have received cash. This is from the lessee's point of view because lessee accounting. Lessee has received a cash, debit cash, 1,000, and credit from right of use asset because they have deducted from there 1,000. Now if you see all, okay, it should be equal. Your debit should be equal to credit. Here you see 1,000, 3,000 and 31,552. Okay. Now we are moving on to the subsequent measurement. This is also important. This is the continuation from initial measurement. Okay. Liability part. Any interest will increase your liability. It's like how interest on loan increases your loan amount. Same for lease also. Lease liability. Okay. So this interest is an expense recognized in profit and loss. And the double entry is debit finance cost, credit lease liability. And if you are making any cash payment, cash repayment, for that lease liability, it reduces your lease liability. This is how debit lease liability, credit cash payment. Next, right of use asset. Subsequent measurement is if you're using the cost model. Okay, if the right of use asset is measured using a cost model, okay, then what happens? That means it is measured at its initial cost less any depreciation and impairment loss. How we normally take under IAS 16 assets, non-current assets, cost minus accumulated depreciation minus impairment loss is the same. Okay, but if, sorry, and depreciation is calculated like this. If the ownership of that asset goes to the lessee, it is transferred to the lessee at the end of the lease term, then depreciation should be charged over the asset's remaining useful life. Let's say asset has a useful life of 10 years. You are in the lease for 5 years only. But after the end of the 5 year, asset is going to you, the lessee. So that means from that 10 years, 5 years went under the lease. You anyway calculated depreciation. Now the remaining 5 years you have to calculate the depreciation because asset transferred to you. See, whenever I'm referring you means you are the lessee. Think yourself as the lessee. Okay. But if asset is not transferred to the lessee, it remains with the lessor at the end of the useful life. Sorry, at the end of the lease term, this is how you calculate depreciation. Shorter of the two. Shorter of the useful life of the asset and the lease term. Whichever is shorter. Let's say useful life is 5 years. Lease term is 4 years. Then depreciation is taken for 4 years. Okay. Now, other measurement models. Previously, whatever I've discussed is under cost model. But if it's a revaluation model, what happens? Let's say if your right of use asset falls under investment property. Okay. IS 40, investment property. What happens? And if that investment property is measured at fair value, then IFRS 16 says, okay, even your right of use asset also should be measured using fair value model. Okay. If your right of use asset meets the definition of the investment property, then that should be measured using fair value model. If lessee measures the investment property at fair value. Okay. Just normally, lessee measures any investment property at fair value. Then for the right of use asset also is the same. If that right of use asset is an investment property, lessee then has to measure it at fair value. That is the meaning of it. Example, right of use asset that are subleased under operating lease in order to earn rental income. Okay, so here they have to use it at fair value, even though subleasee. If during the first time, if you're leasing it, the lessee is recognizing it at fair value, the lessee whom they are subleasing it to, even that sublessee has to recognize it at fair value if it's under investment property. If right of use asset is classified according to IS 16, property plant and equipment, and that property plant and equipment is measured using revaluation model. Okay, that means any plant and equipment that is measured using revaluation model, okay, then an entity will apply IS 16's revaluation model rule for all the right of use assets within that class. Okay, let's do a question. Test understanding 4. This question follows from the previous test understanding, that means test understanding 3. Explain the subsequent treatment for year ended 31st December 2001 for Dynamics Lessee. So I have the answer for test understanding 3 already with me. Okay, now what do you have to do? Subsequent measurement. On your lease liability, you have to calculate interest, finance cost. Okay, so you have to do a small working. Lease liability table. Okay, this is always whenever you have to find the finance cost. Okay, so it's year ended 31st December 2001 and 31st December 2002. Okay, we don't need 2003. Okay, 2 year is enough because they look at the question, they asked for the year ended 31st December 2001 only. You want to know the subsequent treatment. Okay, so opening balance. What was the lease liability? It is 31,552. This one. So you will take it here as opening balance 31,552. Then take interest of 5% because borrowing rate was 5%. Remember, 5% on that. It will be 1,578. It's added to that opening balance. Now any payment, cash payment, that is what, 10,000. And then closing 23,130. You will understand why I have taken for 31st December 2002. You will understand it a little bit later. You might say, why did I add the next year also? Because the question only asked for 31st December 2001. You will understand it. Just watch what I'm doing. Okay. Now this closing becomes the next year's opening. 23,130. On this add 5%, 1,157, deduct 10,000. 14,287. Okay, so now your double entry will be, I told you double entry is very much famous with IFRS 16. You debit your finance cost. How much? This one, first one, 1,578, which goes in the P&L as an expense. Credit lease liability. $1,578. Okay. Now, cash payment. Debit liability. Credit cash of 10,000. And liability has a carrying amount of. So on your statement of financial, what will go? This one, 23,130. It has a carrying amount of this one at the reporting date. Okay. Why did I do the next year? The reason why I did for this 2 year is to find the current and non-current liability. The next year's one will be non-current liability for this year. You understanding? The 2002's figure I have taken is because for 2001 I want to know what is the non-current liability. That is next year's. That's why. Now do you understand? But why didn't I take 2003 then? You could have asked. Because 2003's liability I cannot include it in 2001. It will be included in the 2002. But the requirement only asked till 2001. That's why. Okay. Now, you see you have been given two figure. Closing. Compare the two. So you need to compare this two, which is 23, 130 minus 14, 287. Which is 8, 8, 4, 3. Okay. So, this one is current. And this one, 14287, is non-current. I just wanted to show you this. Okay, so this is non-current, this is current. This 8843. It goes as a current liability. And that goes as a non-current liability. Now, you need to depreciate. Don't forget depreciation. So right of use asset is depreciated over shorter of the two. See, the ownership of the asset did not go to the lessee. So you have to see the shorter of the useful life of the asset and the lease term. Okay. You have to see test understanding 3 for that. It was in the previous question. Lease is for 3 years. Duration is for 10 years. Shorter is lease term, 3 years. So you have to depreciate for 3 years. Okay. You have to depreciate it for 3 years. So we'll find the depreciation. Okay. What is it? Which amount? 33552. Your right of use asset is this one. We found in this one. According to test understanding 3. 3352 divided by 3. 3 years. Will give you how much? 11,184. Even if you are getting in decimal, make sure that you round up to whole figure. 11184. 11184. So here double entry will be debit depreciation, goes in P&L. 11184, and you credit right of use asset. 11184. Next. So carrying amount of right of use asset will reduce. Okay. Because of depreciation. Carrying amount of right of use asset will be reduced because of depreciation now in the subsequent measurement. Reduced to how much? Take the difference. Earlier it was 33552. Now depreciation is 11184. It becomes 22,368. This one. Okay. Next, separating component. Okay. Sometimes a contract may include components, a lease component and non-lease component together. Okay. Partially, part of it contains lease, the other part contains which is not lease. How do you deal with it? You need to, when a price is given, okay, you have to allocate between these two, to the lease component and to the non-lease component. And how is it based? It is based on the standalone selling price of each component. Okay. Next, you can separate these two if you want, or if entity prefers, they can account it as a single lease. Both the lease and the non-lease component, they can take it as one single lease. Okay. So this decision must be made for each class of right of use asset, that you are going to take it as a single lease. But remember, if you're taking it as a single lease, the drawback is it increases your lease liability initially. And this may negatively have an impact on the entity's financial position because it's showing too much of a lease liability. That is not so great. Let's do a question on the separating component. Illustration 1, Swish. So, Swish entered into a contract for 3 years. Okay, it's a contract to lease a crane. Now, the total contract cost is 180,000. Swish pays 60,000 each year. That means 60, 60, 60 for the 3 years. So it adds up to 180. Okay. Now they have a long lease component also. So here, this is what the standalone price for the both. For crane, it is 160. For the maintenance service, it is 40. And borrowing rate is 5%. How do you account for it? On 31st December 2001. So you can clearly understand it's a separate component. One is lease, the other one is non-lease. First, you need to, before you start the lease payment, the lease liability and right of use asset calculation, you first need to allocate the payment. This is the first step when a lease and a non-lease component is given, always. So first step is allocation of payment. Okay, without this you cannot proceed ahead. This is the first step. I'll write it as one. Allocation of payments. Okay, so now they told that each year annual payment is 60,000. But standalone, so for crane and maintenance has been given. So based on that we'll find crane and maintenance. Okay, for crane, what was the price they have given? It's 160,000. Okay, so 160,000 divided by 160 plus that 40,000 of the maintenance, you add the total. So out of total 160 is for crane. And what is the payment? Annual payment is 60,000. Here it is 40,000. The rest remains the same. 160 plus 40,000 and multiplied by 60,000, the annual payment. This is how you find the price. So this is 48 and this is 12,000. Together it should add up to 60,000. That was our whole purpose. Out of the 60, how much is for crane, how much is for maintenance, and that we get from this standalone price, selling prices. Okay, now it's done. So our part is maintenance, we don't care, we only need for the crane. Okay, so now date, cash flow, discount rate, present value, 31st December 2001, 31st December 2002, 31st December 2003, 48, 48 and 48,000. Sorry, I think the one extra zero is here. This is 48,000. Discount rate is 5%. So 1 divided by 1.05, 1 divided by 1.05 to the power 2 because second year, and 1 divided by 1.05 to the power 3 because the third year. This is how you find discount rate, and you multiply discount rate with cash flow and find the present value. 45,714, 43, 537 and 41, 6, sorry, 41, 4, 41, 464. Add 13715. You need this total value. That's why we found for 3 years. Okay. Now there is no direct cost, nothing like that. Okay. So because there is no direct cost, nothing, your right of use asset will be equal to your lease liability, which is 130,715. So you debit right ROUs, ROUA, right of use asset. I'm using initials, okay, the short form, 130,715, and credit LL, lease liability, 130,715. I like when it's like this, right? It looks very easy and simple. But anyway, now comes interest part, subsequent measurement. This is a good question. In fact, it has both initial measurement and with subsequent measurement. So interest, you need to charge interest. For this, we need to do a working one. Okay, so let's go there and find working. Okay, year end. Okay, we'll keep the working here only. Year end, opening. Okay, follow this pattern. Okay, try to follow this only in your exam also. You will never get wrong. Payments and then closing. So year end is 31st December 2001. Opening 130,715. If you charge 5% on it, will be 6536 and payment is 48,000, which is deducted. Closing will be 89,251. Okay. But if you go by the maintenance part, okay, remember maintenance, the 12,000 payment, that is okay. This is for maintenance also. I will explain you, because if in case if that comes, you need to be able to write this is only small portion. Okay, so everything that payment goes in the P&L. So you debit P&L 12,000 and you credit cash 12,000. This is only for maintenance. That's it. Okay, so we are not over with lease. I'm sorry, I finished with maintenance first because I thought it's just one line, better to finish it fast. Coming back to our the lease. Okay, yes. So this is what our interest is. 6536 is our interest. So you debit finance cost. Okay, I'll write here. Doesn't look good. Debit finance cost. Which is in the P&L it goes, and you credit lease liability. How much? 6536. Okay, and then cash payment reduces your liability. So you debit lease liability LL and you credit cash. How much? 48,000. Now how much carrying amount liability will have? Already we have done it here, 89. This is the closing balance. It will go into a statement of financial position. Statement of financial position. This balance will go. And right of use asset you have to depreciate. Okay, so depreciation of right of use asset. How much? Right of use asset was 130,715. Okay, it's divided over the lease term, 3 years. So 43,572. This will reduce your right of use asset. So debit depreciation, credit right of use asset. 43,572, 43,572. Okay, then carrying amount of right of use asset will be how much? 130,715 minus the depreciation, which is 43,572, which is 87,143. Right? Reassessing the lease liability. Sometimes due to some conditions, your lease liability you need to recalculate. Okay, let's say if there is any change to the lease payment. Okay, let's say your lease payment changes, it remains fixed for 3 years. Let's say due to some reasons or some condition or anything, lease payment has changed. Then you have to recalculate your lease liability and your right of use asset. Okay. Once your lease liability changes, recalculated, carrying amount needs to be adjusted. And a corresponding adjustment will be made in right of use asset against the carrying amount of the right of use asset. Because if anything has an effect on the lease liability, will have an effect on the right of use asset also. Remember this. IFRS 16 says regarding discount rate, okay, says that the lease liability should be recalculated using a revised discount rate if lease term changes or entity's assessment of the option to purchase the underlying asset changes. Any of these changes use this revised discount rate, and this revised discount rate should be there in the lease, okay, for the remainder of the lease term. But if it's not there, again you can use the borrowing rate of the lessee, but on which date? On the date of the reassessment. So let's do a small question. Test understanding 5. Kingfisher. So here you are supposed to first account for the lease during the first year of contract and during the second year. Okay. So here it's a 4-year lease with annual lease payment of 1 million. Now lease payment increases every year on the basis of CPI, Consumer Price Index. CPI is 25 at the commencement and it increases to 140 in the second year. Okay. Now the interest rate is 5%. So let's see here. Okay. First, whenever you are given 2 separate years, always start with the first year and you need to put a subheading. This is the answer. I've copy pasted for you. Okay. Because I thought me writing down answers, it takes a lot of time. So better through this answer, I will explain you, because I have been doing this for a multiple time now. So you have got the setting right now. So now if I disclose you the answer, it's no harm, because in the beginning I have already done this question. Okay, this is just that in the second year lease payment changes, how you deal with it. Rest everything else remains the same. You calculate right of use asset, then lease payment, then interest, then depreciation, all those things are same. Okay, except in the second year change will come. Okay, so in the first year you see annual payment is 1 million. So first year nothing happens. First year right of use asset debit and cash credit 1 million. Okay. Now, so liability also will be 1 million. Why? Because in the first year index remains at 125. Index does not change. Nothing happens in the first year. Only in the second year index changes. Okay. Because these payments are variable. In this case, it is dependent. This time they do not have a fixed payment. Okay. I mean, obviously 1 million is there, but other than that, it does not change. Okay. It is assumed that the index will remain at 125 and so the payment will remain at 1 million in this year, because price changes based on index. If index change, price will change. So here for the 3 years, 1 million, 1 million, 1 million payment, discount rate is 5%. So this is how we discount and find the present value, and this is the total we got. So we debit right of use asset with this amount and you credit lease liability. Because there is no direct cost or anything like that, this both are same in this case. Now right of use asset needs to be depreciated. That is subsequent measurement. Initial measurement is done. Okay, so it is lease payment. For how many years? 4 years. Okay, remember. Here right of use asset was 1. Here it is 2.72. That is debited. Because this 1 million is the cash. Okay, cash payment. The first payment occurs on the commencement date, so it is included in the initial cost of the right of use asset. That's why. And this one is when you are finding the present value, lease liability. This right of use asset, 2.72. So you add 1 million with 2.72 and divide by 4, because 4 years. So depreciation is 0.93. So depreciation debit, credit, lease right of use asset. Now carrying amount of asset will be 1 plus this and minus depreciation, which is 2.79. Now let us go to the leased liability. The interest is 0.14. So we have to go to working one for it. You see opening balance is started with 2.72. That is your lease liability. Add 5% and you will get the closing balance 2.86. But this is interest that you have to take in the finance cost. So debit finance and credit lease liability. Carrying amount is this. So first year is done. Okay. Now comes the second year. Second year, consumer price index increases to 140. So because it changes, your payment will change from 1 million to 140 divided by 125. The new year, the second year index divided by the previous year's index. This is the method into 1. Okay. It should be more than 1 because they told every year it increases based on consumer price index. Every year the payment increases. It should be more than 1. If it was the other way around, 125 divided by 140 into 1, answer would be definitely less than 1. Try in and check. So it cannot be. It's wrong. It's 140 over 125. The new later divided by the old, which is 1.12. So this is the payment for the remaining 3 years. You see, lease term was for 4 years. But now in the second year when you come, you have 1 year went. The past 1 year, now remaining 3 years. So now the payment is 1.12. So 1.12, 1.12, 1.12. Just wait, just a minute. Okay, here, one thing I want to say, they told 4-year lease and you have only taken for 3 years in the first year. Why not 4 year? Because this 1 million payable at the beginning of the each year. Immediately they have paid. Okay. And for the other 3 years only, they are finding the present value. You don't have to find the present value for the first payment. That is on the first date they have paid. But thereafter onwards, it's year end. So it's first. This 3 will be are to find the present value. And this 1 million, it is separate. That's why we have added it at the end. Okay. I just wanted to clarify that thing. Here, everything you can find the present value. 5% discount rate remains the same. And you find the present value 3.21. Now, you see, earlier it was 2.72. 2.72. So from 2.72, it increased to, sorry, not 2.70. You have to look the closing balance, 2.86. Because closing balance of the previous year becomes the opening balance of the next year. So from there, it went up to 3.21. So it increased by 0.5. If you take the difference, you will get. Now make a corresponding adjustment. Because lease liability increase, right of use asset also will increase. So debit use of asset 0.35, credit this with liability. Now payment of 1.12 will reduce the lease liability. So debit lease liability, credit cash with that amount. Right of use asset, depreciation will change. Before it was 2.79, it has increased by 0.35, now divided by 3 years to find the depreciation, which is 3.14. This is the carrying amount, sorry. Okay. Now next is short-term lease and low-value assets. Remember in the beginning I told short-term assets and low-value assets, you don't have to find lease liability or right of use asset. There is simplification for this. First understand what this two means. Short-term means when you went for a lease, okay, it is less than 12 months. 12 months or less, it is known as short-term. And or if it's of a low value, there's a simplified treatment. What is the simplified treatment? We'll see later. What about low value? Low value means you have to look at the value of the asset when you first bought it. Okay. If it's low that time, then it is taken as low value assets. Okay. But IFRS 16 did not give you any monetary amount to say that below this it's a low value or above this is a high value. Nothing like that. Some examples like your tablets, PC, telephones, and small items of furniture. If you go for a lease, these are known as low value assets. So for how do you treat these items? These items, okay, you write it on a straight line basis. You recognize this lease payments in profit and loss on a straight line basis. You do not recognize a right of use asset and a lease liability. like how we have done for the other leases. You see, you must have noticed something. All the leases are more than 1 year, 2 year, 3 year, 4 year, 5 year, like that. So they are not short term. That's why we have to calculate lease liability and right of use asset. But if it's less, then it's a short term lease, and you just recognize the lease payment as an expense in profit and loss. That's it. You can choose, the lessee can choose it. There's a choice given that they can recognize it like this. Okay. And when you're making the assessment of low value, this means when it's new, what is the value? For example, a car. If you take a car will not qualify as a low value asset because cars are very expensive when you're bringing it for the first time. Even if it was old at the commencement of the lease, even if you are having an old car, because car generally is not a low value asset. You see, so you cannot take it as a low value asset. Then lease disclosure. What are the lessee disclosure? What are the things that you need to disclose? See, if right of use asset are not separately shown in the statement of financial position, then you have to include it in the line item. Okay, that would have been used if assets were owned. Okay, entity have to disclose it. Which line item includes right of use asset? Now, these are the following disclosures for leases. Okay, lessee. The depreciation charge on right of use asset. Interest expense. This amount needs to be there. Interest expense on lease liabilities. Expense relating to short term and low value asset. Cash outflow for lease assets. Right of use asset additions. Carrying amount of right of use asset. And a maturity analysis of lease liabilities. Okay. Next. So that's it with lessee accounting. We are done. We will be moving forward to lessor accounting. Lessor accounting. So we are just over with lessee accounting. Now it's lessor. Okay. Here, lessor needs to classify leases as finance or operating leases. Okay. It's a finance lease when risks and rewards of that asset transfers to lessee. And it's an operating lease if it does not meet the definition of a finance lease. That means risks and rewards still stay with the lessor. Then it's an operating lease. Okay. Now, how to classify a lease? If one of these conditions is there, it's a finance lease. Okay. But the thing is, ownership needs to be transferred to the lessee at the end of the lease. Now we'll see. Number one, the lessee has an option to purchase the asset less than its fair value. At the date the option becomes exercisable. Okay, and it's very certain that you're going to exercise the option. What was the option? To buy the asset at the end of the lease. A lessee should have that option, and it should be reasonable that it will be exercised at less less than expected fair value. Okay, it's a finance lease. Number two, the lease term. The lease term should be for the major part of the asset's economic life. Okay, including any secondary period. What is the secondary period? Sometimes what happens is when you are giving it to a lease, lessor is giving it to the lease to the lessee. Lessee is further giving it to the lessee to someone else, subleased. So that period is also included. That secondary period is also included in that lease term. When you're taking the major part of the asset's economic life. We'll do a question to understand these points. Third point that says it's a finance lease. When you are at the start of the lease, the present value of the lease payment, okay, to be at least substantially all of the fair value of the leased asset. Fourth point, leased assets are of specialized nature that only lessee can use them. If lessee does not use it, another person will not be able to use it because it is only for the lessee. So it's a specialized nature only for lessee and without much modifications. Okay, then the lessee will compensate the lessor for any losses if the lease is cancelled. So here who is bearing the risk? The lessee. Wherever the lessee is bearing the risk, it's a finance lease. Because why? Ownership should transfer to the lessee. Okay. Then any gain and losses in the fair value of that asset. Okay. Who bears it? The lessee. Okay. For example, by means of rebate of lease payment. So here you see risks are being borne by whom? Lessee. If there is any changes in the fair value of the asset, if the lease gets cancelled, So all these are examples of finance lease. If these are there, it's a finance lease. And the last one, the lessee can continue the lease. Lessee can still continue the lease for the secondary period, as I told you, right? In exchange for substantially lower than market rates, market rate payments. You have to accept payment lower than the market rent payment, but you can continue. The lessee can continue. Okay, now let's do a question. Test your understanding 6, Dan Bob. Okay, so Dan Bob is a lessor and he has drawn a lease agreement for building. Okay, building has a useful life of 50 years, lease term is 30 years. Okay, Dan Bob, that is the lessor, will receive 40% of assets value upfront from the lessee, and Dan Bob will receive 6% of the assets fair value at this date. Okay, legal title at the end of the lease remains with Dan Bob. That means legal title has not been passed to the lessee, but the lessee can continue to lease the asset below its market rent. Okay, if the lessee cancels the lease, it must make a payment to Dan Bob. You see, if he cancels, he has to make a payment to Dan Bob to recover his remaining investment. According to IFRS 16, you have to say this is an operating or a finance lease. You have to look at the facts. So we know that if, okay, from my previous slide, you can just say that it's just a copy paste because this is a knowledge based answer with little application to the case study. Okay, so IFRS 16 says when risks and rewards are transferred to lessee, it's a finance lease. All these 5 points, remember, this is what we have explained. This is just a copy paste. That first one explains ownership has to be transferred. Second says major part should be assets economic life, the lease term. Third, present value of the lease should be substantially of the fair value of the asset. Fourth, if the lessee cancels the lease, lessor losses are borne by the lessee. And fifth, they can continue, the lessee can continue the lease for the secondary period, but substantially below the market rate payment. Okay, so this is your knowledge part. This is what you have studied in IFRS 16. Even in your exam, SBR exam, this is how you need to answer. You first need to give what you know, that these are the conditions that needs to be fulfilled for it to be finance lease. If you say you are not in any of those 5, it suggests it's an operating lease. Now we'll apply. This is from here, all this is application. This is why I have copy pasted this answer to show you. Okay, now each point they will take the first point and see with the case study, second point, third point, fourth point, fifth point. Now they will apply it to the case study, each one. Okay, so first, okay, they are leaving the first and we are going to the second point. They're starting from the second point onwards, the lease term. Okay, even this is lease term, the second point. So we'll see whether it's for the major part of the asset or not. Okay, see, lease was for 30 years. Useful life of asset was 50 years. If you take it in terms of percentage, it is 60%. Okay, so the lease term is not for the major part of the asset's economic life. It is not. Even if you check the first one about the ownership, okay, the legal title also does not pass to the lessee. So these two factors suggest it's an operating lease. Okay, this is how you need to answer. When you see that out of this 5, you can take some points which says it's an operating lease, or you can start by saying that these are the points which says it's a finance lease, and then you can suggest by saying it's an operating. Anyway, you can answer. First, here what they have done, they have told that give the 2 points and told it's an operating lease according to these 2 points. Why? Because not major part of the lease term is for assets useful life. Second, legal title did not transfer to the lessee. Now we are moving on. However, this is a connecting word. Even though it says it's an operating lease, but it's not a conclusion. We still have some more points. The other 3 points. Based on the other 3 points, it's a finance lease. We'll see how. What about renting? What about the secondary period? That is the 5th point, right? It says the lessee can continue to lease the asset at below the market value. So this says it's a finance lease. Point number 5, according to point number 5, it's a finance lease. That's why I just put a circle for you to understand. Next, you see there's a space. Each point you will explain in different paragraphs. If you're taking 5 points, 5 different paragraphs. That's how you apply. Okay, application. Next is what? About the cancellation, the fourth point. Lessee cannot cancel the lease without paying the envelope. So this says, who is having the risk of ownership? The lessee. Again, it says it's a finance lease. So fourth and fifth point says it's finance lease. 2 for operating, 2 for finance. Okay, see, your conclusion is based on the majority points. Okay, whichever side has more points. Here now it's like 2 versus 2. 2 points for operating, 2 for finance. Now 1 more point for finance, and it's a finance lease. Okay, that's how you answer in SBR or any paper in ACCA. That's how you decide. That's what your conclusion is. Obviously, there are other factors, but it's not possible to include all the factor. Okay, we go by the whichever points have major points. Okay, anyway, so this is the third point. That means your conclusion is that it's a finance lease, because 3 for finance, 3F, and 2 for operating. So finance bond, it's a finance lease. Okay, what is that third point? Fourth and fifth are over. It's about the present value, the third point. So third, fourth, and fifth. According to third, fourth, and fifth, it's a finance lease. According to first and the second, it's an operating lease. What is the fifth one? Present value. Is the present value all of the substantial of the assessed fair value? We'll see. They have already given you that is 40% of the fair value that is paid upfront. It's given in the case study. Okay, that is the minimum lease payment. And then another fair value over the lease term. What is it? 30. See, lease term is for 30 years, and each year you are getting 6%. That's what they have wrote here. They will receive 6%. This is upfront. 40% is upfront. They will receive the first year. Thereafter onwards, every 30 years, 6%, 6%, 6%. This will continue for 30 years. That's why 30 into 6%. Okay. So if you go by that, of course, they are saying the present value of the minimum lease payment will substantially all of the assessed fair value. So it's 180%. It is substantially all of the assessed value. Therefore, it's a finance lease. So you conclude it's a finance lease. This is how you need to answer. Okay. Now, finance leases. Okay. What is the initial treatment of finance lease? At inception, okay, lessor's present assets held under finance lease as receivable. Why receivable? See, take it like this. It's like a sale on credit. Okay, where you are selling it, okay, but you have not received the amount yet. Okay, so initially means the first day of the lease when you are entering. Okay, you are going to sell the lease, or you're going to transfer the lease to the lessee at the end of the lease term. But before that, it's a receivable. You will keep on receiving from lessee in installments. So it's receivable. Okay. So under finance lease, you record it as a receivable. And the value of this receivable is calculated at the present value. Why? Because you are going to make this payment at the future. But you want to know what is the value today of that payment. That's why present value. So fixed payment. Okay. So this receivable will include fixed payment, variable payment. This variable payment depends on index or rate. They will give you in the exam. What is this index or rate? Third, residual value guarantees. Unguaranteed residual values. Purchase options that are certainly reason to be exercised. That means if the lessee has an option that you are going to buy the lease at the end of the lease term. And termination penalties. If the lease term reflects the expectation that this will be incurred. Okay. That means lessee is going to pay the lessor for if they cancel the lease, or for some reason, if any reason the lease cancels, lessee has to pay the lessor. This is also included in the initial treatment. Okay. I mean, it's a part of a receivable. When you're calculating receivable, you have to add all this. It's like plus, fixed payment plus, variable payment plus, residual warranty. All this are addition. But in your exam, obviously, there will be not everything will not be there. Maybe 1 or 2 items. Okay. But you have to know if it's there in this list. If it's there, you have to add it. Okay. Now we are moving on to the subsequent treatment. Subsequent treatment of finance lease is this. Carrying amount of the lease receivable is increased by any finance income earned. Okay, see, whatever the lessee is paying you for using that asset every year, it's a finance income. You add it with receivable, it will keep increasing. Okay, even that finance income is credited to statement of profit and loss. It's an income. Next, any cash receipts, okay, the carrying amount of the lease receivable is reduced by the cash receipt. Okay, so we'll do a question now shortly to understand this initial treatment and subsequent treatment. Test understanding 7. So here in test understanding 7, machinery is leased. Okay, where she has leased machinery to Toro. The lease is for 4 years. Annual cost is 2000, payable annually. Present value, to find the present value, 15% is the interest rate, and lease payment is 571. The present value of the lease payment is 5710. They have already given in the present value. The interest rate also they have given. Why? To find the finance income. Based on this interest rate only, you are going to find the finance income on receivable. That's why. Okay. How they should account for this net investment in the lease. This is for 4 years. Okay. So here, remember this amount needs to be recognized as receivable. The lease payment. The present value of lease payment. It's a fixed payment. Okay. Now, this will be increased by the finance income and reduced by cash receipt. So you have to make a table now. Okay, this question, if you get in your SBR exam, you have to do it in Excel, because now all your exam are on CV. Okay, it's not paper written anymore, so you have to use Excel. So the best thing that you can, I'm doing it manually here, you can do it in Excel. It will be much quicker. So here, first column is year, then opening balance, then comes your finance income. Finance income is 15%. Then your cash received. This is a receivable, so you're receiving cash, and closing balance. This will be the columns. Okay, how many years? 4 years. So 1, 2, 3, and 4. Opening balance is 571. They have already given 5710. Take 15% on this. You might get some decimal. Try to take up round up figures. Okay, 856, because it's easy to work out with whole number. 856. And what is the annual payment? 2000. They have already given you. So every year is 2000. That will be reduced. This is fixed. Okay, cash received 2000. So annually they are receiving 2000. Okay, so here closing balance will be 5710 plus 856 minus 2000. 4566. This closing becomes the opening of the second year. 4566. So you have to do it horizontally. You cannot do it vertically, because you need the closing balance of the first year to find the opening balance of the second year. And likewise for all the other years. 15% on this, 685. Here it will be 3251. Then here it's 3251. Take 15%, 488. It's like I'm teaching maths. Okay, 1739261, and here it will be balanced. The balance should go out at the end. Should be nil. That's the whole purpose. Now, the requirement is how they should account. This is not enough. You should, how they should account means in your statement of financial position, statement of profit and loss, how it will appear. That's what you have to show. So this goes under non-current assets. Okay, that is net investment in finance leases. How much? See the, okay, first you have to find for the current asset. Wait a minute, there's a working here. Current asset. Okay, net investment. These are extras from statement of financial position in FL, finance lease. Okay, there's a working for it. So the current asset is the next installment less the next year's interest. So the next installment is 2000 only every year minus that is the next interest. Next interest is this. Okay, 685. You are getting how much? 1315. This is your current asset. 1315. Non-current asset is the balance, remainder. So what is here? You see, closing balance is 4566. Okay, 4566. From here, take out the current asset, that is 1315, which is 3251. If you see this one, you see closing balance of the second year is a non-current asset here. Why? Because it moves beyond this thing, 12 months, end of the second year. So it's more than 12 months. So it will more than 12 months means it's a non-current. It cannot be under current assets. So 3251. But why we have to do this working? Because we want to find the current asset first. This anyway, if you do this method or just write 3251, non-current asset is fine. But what about the current asset? Right? Or otherwise you can do it like this also. Just find the difference between these two. This will give you the current asset. Because 3251 is a non-current asset. So 4566 minus 3251. The difference is 1315. This is your current asset. Out of this 4566, current asset is 1315 and 3251 is your non-current asset that you have to record this year. This is like your receivable table, trade receivable, how you do that, right? Next is operating lease. Operating lease is easier than finance lease because less work. Okay, operating lease means here Lessor recognizes income from operating lease on a straight line basis over the lease term, and any direct costs of negotiating the lease are added to the cost of underlying asset and then depreciated accordance with IS 16 or IS 38. Okay, it will be depreciated if it's an intangible asset according to IS 16, or it will be amortized if it's an intangible asset according to IS 38. Let's do a small question. Test understanding 8 org. How he accounts for the above crane. So he has ORAC hires out an industrial plant on a long-term operating lease. Okay, they have already given the word operating. But even then you can understand because it has all the things that applies for finance lease are not here. Okay, what is the lease term? 7 year. 7-year lease. 175 are payable by followed by 6 rentals of 70,000 payable. That means for 6 years they are going to pay 70,000. Next. So that makes up total 7 year. First year 175 and second, third, fourth, fifth, sixth, seventh. That means 6 years they are going to be 70,000. 70,000, 70,000, 70,000. Okay. Now, originally the crane cost 880,000 with 25-year useful life. Okay. So how do you do this? First, find the depreciation. Okay, that is 880,000 divided by 25 years, which is 35,200. Without taking the lease and all, this is the depreciation. 35,200. Okay. Now, coming to the lease, rental income. You have to recognize rental income because this is an operating lease. Rental income. You are getting income from rents, no? So rental income. Where this will go? P&L. It will be recognized in P&L on a straight line basis. So what is the total lease receipts? see, they are paying 175,000 first year, followed by 6 rentals. So 6 into 70,000. Okay, the total will be 595,000. Now this also you need to depreciate. You have to give, see, this is a total lease payment, but you have to find only for this year, first year. So you divide this by 7 years because lease term is for 7 years. Okay, so annual rental income is 85,000. Annually you are going to pay annual. This is annually 85,000. Now, so in your statement of financial position, okay, statement of financial position, I'm using the initials, okay, SOFP. There will be a liability for deferred income. This is how you recognize an operating income when it's for many years, okay. This is not yet your income. There's a liability for a deferred income because on this date, okay, see, you can only recognize income after 7 years, right? When you're actually getting all the receipt. But now for the first year, the other 6 are just, it's a deferred income. It's still not your income yet. That's why there's a liability for deferred income that you need to recognize in your statement of financial position today, okay, for the future receipts. So you see, this year it is 175,000. This is your receipt this year, they told. Here, you see, this is payable on 1st of Jan 2001. For this year, it's there. But out of this, 85,000 you have to deduct. Because 85,000 is a deferred income. So out of this total income, 85,000 you have to take out. The balance is the liability for deferred income. 85,000 is your income, correct? It will go, this will go in your profit and loss. But as a liability, you have to deduct it from 175,000, the income, which is 90,000. Okay, I hope you are able to understand this. Lessor disclosure. Okay, so for lessor, the disclosures are this. Okay, they have to present in the statement of financial position according to the nature of the lease, whether it's an operating or a finance lease. Okay, so these are the things for finance: profit or loss arising on the sale. Because finance lease means what? You are ultimately transferring the ownership of the lease to the lessee. That's why you have to, lessor has to calculate a profit or a loss on the sale. Then finance income. Then data about the changes in the carrying amount of the net investment in the finance lease. A maturity analysis of lease payment receivable. For operating lease, lessor should disclose a maturity analysis of undiscounted lease payment receivable. Okay. Know the rules and also know the disclosure part for your SBR exam. Okay. Now, sale and lease back. This is the last topic in IFRS 16. Okay. We have touched about lessor accounting, lessee accounting. Okay. Now we are moving on to sale and lease back. This is the last part. Now, sale and lease back means what happens? The seller, okay, the lessee. What happens once the lessee has taken something on lease? Okay, they sell it to another entity. They sell to another entity and then again lease it back from them. Use it under you again use that asset, but they don't buy it back again after selling it. Rather, they lease it back. Okay, so this is known as sale and lease back. So in this, the seller is the lessee. Why? Because he has sold it to another entity, and lessor is the buyer. So it changed. Okay, lessee is the seller, buyer is the lessor. Now both entities, both lessee and the lessor, have to see that the transfer is accounted as a sale or not, because it says sale and lease back. If it's the transaction is a sale, then some rules apply. If it's not sale, then some other rules apply. You need to know this. Even this has been tested in SBR, sale and lease back. Okay, so for this purpose, you need to apply IFRS 15 if sale has taken place. Why? Sale says performance obligation must be met. So, okay, And normally this occurs when control of the asset passed to customer. Control of the asset means whoever is getting the benefit of that asset, who is having that benefit. Now we'll see. If the transfer is not a sale, IFRS 16 says you to do this. Because it's not a sale, okay, so when you sell and lease back, okay, the transfer is not a sale. If it's not a sale, then the seller, the lessee, continues to recognize the transferred asset. See what happens when something is not a sale? You recognize the asset, no? So here also is the same thing. The lessee, who is the seller, continues to recognize the transferred asset and recognize in the statement of financial position a financial liability that is equal to the transfer proceed. That means whatever transfer proceed is there, that is financial liability. Why financial liability? Of course, financial liabilities I have explained in IFRS 9 in depth, but how is it linked to here? You must be thinking. Think. What is the meaning of financial liability? An obligation to pay. An obligation to pay in cash, or an obligation to pay a financial asset, an obligation to pay anything where there is an obligation, but it has to involve cash. But that's why financial liability. Otherwise, it would be non-financial liability, right? Because they have an obligation. Who? The lessee has an obligation to pay to lessor. Okay. Why? See, it was a sale, but according to IFRS 15, it was not a sale. Okay. And a lease back. So because you have leased it back, you, the lessee, the seller has to pay to the lessor, the buyer. Understood? Don't think from the point of seller that because you have sell, you are going to receive. Think it in this way that lessee has sold and now leasing back. So again, lessee becomes a lessee once they are leasing it back. So lessee is going to pay to the lessor. So they have an obligation to pay to the lessor. That's why it's a financial liability. Okay. Next is the other way around for the lessor. Just switch it. Lessor, because the lessee is leasing it back from the lessor, who is going to receive the cash? Lessor. Lessor is receiving it, the buyer. So he will recognize a financial asset, because financial liability for one party means financial asset for another party. Okay, we all know it's very common. If it's a liability for you, for the other party it's an asset. So it's the same here. This is also equal to the transfer proceed. Buyer will not recognize the transferred asset because it was not a sale. You must be thinking, I have bought something, so I will recognize it as an asset, right? As a buyer. No. Same way, seller also continues to recognize the transferred asset. Buyer will not recognize the transferred asset. Okay, if it is not a sale. So in simple term, this transfer proceed is treated as a loan. It's like a loan you have given. You can take this as a loan. It was not a sale, but you can say I have just given a loan. If you want to know the detailed accounting treatment of financial asset and financial liability, please go back to my IFRS 9 lecture and check it. It's a big lengthy lecture, but specifically in the beginning of the lecture, you will see financial asset and financial liability only, not the other stuff. There are so many other stuffs also later on, but I think in the first 1 hour, you will get about financial asset and financial liability discussion. It's a big lengthy video. I think it's more than 4 hours, right? Now moving on to, if the transfer is a sale, then IFRS 16 says this. See, whether it's a sale or not, exam will tell you. In the exam, SBR exam, they will write it, whether transfer is a sale or not. Accordingly, you will deal with it. If it's a sale, then the seller lessee must measure the right of use asset. Why right of use asset? Because he sold it and he's leasing back. Now he's taking it on lease again. That's why right of use asset. Who recognizes a right of use asset? Lessee. Lessee recognizes. So lessee is the one who's leasing it back again. So lessee remains lessee. Okay. He sold first. That's why seller, we said lessee is the seller. Because first he sold. Then he leased back again. So he again reached to the same condition where he was. He's a lessee. That's why he will recognize right of use asset, but as a proportion of the previous carrying amount that relates to the right retained. Previously, he had more rights before selling it off. That's why as a proportion of the previous carrying amount that relates to the right retained. Obviously, some rights you must have retained. Not everything you must have sold. Now, this means seller the lessee will recognize a profit or a loss based on only the rights that are transferred to the buyer and seller. Only that you have transferred to the buyer and lessor, only on that right you will recognize profit and loss. Who? The seller, because you have sold it. Then what about the buyer? See, you have to know both the sides, okay? Lessor also, lessee also, lessor, both the sides. Seller, buyer. Lessor, he's a lessor again, because first what happened? Lessee sold it to a company. Whoever he has sold it, okay, and he have leased it back. So once the moment lessee leases back, the person whom the lessee has sold, that entity becomes the lessor now, because from him he's leasing it back. That's why lessor accounts for this asset purchase using IS 16, because he have purchased that asset. When the transfer is a sale, I'm talking about. It was sale. Lessee have sold it to lessor. So lessor accounts it as an asset purchase according to IS 16. IS 16 is a very common standard, by the way, right? Usually they don't give very tough standards like IFRS 9, non-financial asset purchase, or intangible financial asset. No, they usually give normal non-current asset, right? The lease is accounted for by applying lessor accounting requirements. Lessor has to apply, obviously, lessor accounting requirements. The first part was for sale. When it's a sale, asset purchase. And for the lease part, when you're leasing it back, lessor accounting requirements. That means whether it's a finance and operating lease. The lessor will apply that. Now let's do a small question. Test understanding 9, painting. Okay. So here, painting have sold an item of machinery to college. Okay. At 3 million, fair value 3 million. Asset had a carrying amount of 1.2 million before the sale, prior to sale. Now this sale is satisfied according to IFRS 15. That means it's a sale. Okay, I'm not reading the entire question, but I'm just briefly telling you what is the case study about. So it's a sale because it satisfies performance obligation. Now they have entered into a contract, lease contract for 5 years. Okay, annual payment is 500,000. Interest rate is 10%. Present value is 1.9. But this payment is much greater than the lease term. I mean, the useful life of the machine is much greater than the lease term. Why have they given the last line? For you to decide whether it's a finance lease or an operating lease. This for you to decide this. So this is a sale and a lease back, and IFRS 15 satisfy. So it's a sale. Transfer is a sale. First understand this. The transfer is a sale. How do you account for this now? By both painting and collage, both the party, lessor and the lessee. Painting first have sold to collage, then leased it back from them. So here, because painting have sold it to collage, remove the carrying amount of the machine. Okay, first we'll talk about painting. Start from painting. The best thing to start is with the one who has sold it. Okay, it's the starting point. So painting, must remove carrying amount. This is the answer. Okay, carrying amount of machine, because you have sold it off, so you no longer can recognize machine. Okay, instead, because it's a lease back now, instead recognize what? Right of use asset. Okay, and this right of use asset also, right of use asset will be measured as a proportion of the previous carrying amount that relates to the right retained. Okay, I'll write it down for you. So the next time you get a question, you can just copy paste this line. Will be measured as the proportion of previous carrying amount that relates to rights retained by painting. So what is the carrying amount? Here, present value of annual lease payment. This you have to take as right of use asset, because we told right of use asset is equal to lease payment if there is not any direct cost or anything like that. So 1.9, this is your right of use asset, present value. Okay, so 1.9 divide by, this is your right of use asset, but as a proportion of the previous carrying amount. Okay, now carrying amount was 3 million of machinery, previous carrying amount, 3 into what? Into this 1.2. This is the previous carrying amount before the sale. Okay, so painting sells an item, this is the amount that they have sold it at. Okay, 3, 1.2, this is the previous carrying amount. Okay, this 1.2, always this you will multiply the previous carrying amount. This is the 1.9 is the present value of lease payment, and this 3 is amount sold, amount that sale has taken place. So 3 million is for the sales, 1.9 is the present value, 1.2 is the previous carrying amount. It's always like this. For any question, only the figures will change. 0.76 million. Okay, now entry. This is the double entry. You should know the double entries. Okay, so you debit cash because you're receiving cash. How much? 3 million because sale has taken place. Then you are debiting right of use asset, of course. How much? 0.76. This is right of use asset. Then you need to credit machinery because you are selling it. How much? This, because this is the previous carrying amount of the machinery before the sale. So this is now you're crediting it, 1.2. Then credit lease liability. How much? They've already given 1.9. And there should be, if you add up your debit and the credit side, always you have to do this. Whenever double entry is there, it should match. Debit should always equal to credit. If it's not, something is wrong. You're missing out on something. And here also, if you add up the debit side is 3.76, 3 plus 0.76, and credit side 1.2 plus 1.9. How much? 3.1. So it's 3.1. So you see it's not matching by 3 point. I mean, if you take the difference, 0.66. There's the difference. Which side is less? Credit side is less. So you have to credit what? Profit and loss. Exactly. Because sale has taken place, there will be a profit and loss. So P&L. This is the balancing figure. This happens only when it's a sale. So 0.66. Now it balances. 3.76 and 3.76. Now you can get this figure also through another way. How? It's a proportion of the overall gain on disposal that relates to the right that has been transferred to college. What is the gain on disposal? See, you have sold it for 3 million. Okay, but what was this one? Machinery value was, carrying amount was 1.2. What was it? 1.8. This is the overall profit and loss for the disposal, right? But you have to find according to the portion the right that has been transferred to college. So it will be like this. This is an overall profit from disposal. Know both the methods. Okay, so you have sold it for 3 minus lease liability you have to credit. Okay, right of use asset. 1.9 is also your right of use asset. So from 3 million that you have sold, deduct your right of use asset, divide by 3 into 1.8, the overall profit, and you will get 0.66. Why did we do this? To find the profit that refers to the rights that has been transferred to college. That's why. And this is the method. From your sales figure, minus right of use asset. Right of use asset you will get from your lease liability, this one, and divided by sales again into overall profit, OP. This is the method you need to remember, memorize it. It will work wonders for you on the day of your exam. Okay, now. So right of use asset and lease liability will then be accounted for using normal lessee accounting rules. Okay, now we are coming to the collage. Done with painting. Painting has more work to do than collage. Collage is a lessor. Okay, he will recognize this asset because it has been sold to him. So debit machine for him and credit cash. He has to pay in cash. How much? 3 million. It has been sold for 3 million. So here for him lessor accounting rules. Lessor accounting rules will apply for college. Okay. Now, lessor accounting means finance or operating. F or O. Tell me whether this is a finance lease or an operating lease. By reading this line, you will understand. This is an operating lease, by the way. Answer is O. How? You have to give reasons. Because the present value, you see, present value is not substantially the same as the asset's fair value. And the lease term is also not for the major part of the asset's useful life. So two reasons are there. Shall I write the two reasons? Okay, I think you'll be able to do it. Okay, so college will record, because it's an operating, college will record rental income in profit and loss on straight line basis. Now, transaction not at fair value. If the sale proceeds or the lease payment are not at fair value, how do you deal with it? IFRS 16 says if your sale proceeds are less than the fair value, asset's fair value, that means below market terms, then you need to treat the lease payment as a prepayment of lease payment. And if it's above market terms, that means sale proceed is more than the asset's fair value, then it is treated as additional financing. Memorize these 2 points. Below market term, above market term. Now let's do a question. Now illustration 2 mosaic. Okay, so here he sells an item of machinery to ceramic. How much? For 3 million. Sells for 3 million. Fair value was 2.8. Carrying amount of asset was 1.2 before sale. Okay, this sale represents this according to IFRS 15, so it's a sale. Okay, now Mosaic enters into a contract for the right of use asset, that means sale and lease back, for 5 years. Annual payment 500,000. Interest rate 10%. Present value 1.9 million. How do you account for both this mosaic and ceramic? It's the same thing. Okay, first understand whether below market term or above market term. How do you understand that? Check the sale and the fair value. Sale took place for 3. Fair value was 2.8. Above market terms. So above market terms means this is additional financing, because sale value is more than fair value. Okay. Now, additional finance. Okay, so present value of lease payment. Is how much? 1.9. It's here. Now, it is assumed that 0.2 relates to the additional financing, because the difference between 3, the sale and the fair value, 0.2. Okay, out of the 0.2 relates to additional financing. So out of this 1.9, 0.2 additional financing. Okay, additional financing that mosaic has been given, and remaining, that means 1.7, the balance is for the lease. Now let's do Mossack. How he will treat this. It's the same like the previous question. Everything is same. Remove the carrying amount of machinery. Recognize right of use asset according to the proportion of the previous carrying amount. Okay, so let's do that. It has been, okay, 1.7 is only for lease. So now we are not taking 1.9. No, we are taking 1.7. Okay. So right of use asset. As I told you, right of use asset is equal to the present value of lease payment. Now it's 1.7. Divided by what? Sales. You have sold it for 2.8. 2.8 is the fair value. Okay. 2.8 is the fair value. Multiply by what? What did I tell you? Previous asset of the assets carrying amount before sales. That's 1.2. Here you are not taking sale, by the way. Okay. No. Earlier you took sale. Why? Because this is additional financing of 0.2. When you have been given both the sales and the fair value, and you see sales is more than fair value, then you take the fair value. But when it's only sales, nothing has been mentioned about fair value, you cannot find out this additional financing and all those things. Then it will be sales. Okay. So it will be 0.73. Right of use asset. Now entry, double entry. So you are receiving cash, sale, debit cash, debit right of use asset, and credit machine, credit lease liability, credit financial liability. It's a financial liability when your sale is more. Okay, now you have to recognize a financial liability also. We don't know. Okay, so cash is how much? You have sold it for 3. Right of use asset was just now we calculated 0.73. Machinery was 1.2. The previous carrying amount, this one. Lease liability, now it will be 1.7, not 1.9. Because financial liability, that means additional financing we told, is this only, financial liability 0.2. If you add up your debit and credit side is less. That means there's a profit. Credit P&L, balancing figure, how much? Do on your own and check. You should get 0.63. This you will also get through another way. Exactly the same thing I've done it in the previous question also. So I will do it a little quicker this time. Find the overall profit from the sale. You have sold it for 3 million. Sorry, not 3. Fair value was 2.8. Fair value before before the sale, okay, was 1.2. So it was 1.6. Okay. This 1.6 relates to the right that has been transferred to ceramic. So 2.8 minus what? 1.7. Why? It is your lease liability. Also your right of use asset. That means before the sale. And leaseback, okay? Divided by 2.8 into 1.6, the overall profit. I know this is a little confusing, but you have to keep doing it and see the pattern. If you pick up similar questions in the past paper, you'll be able to understand this better. 0.63. You will get exactly the same figure. Try to get it both the ways, okay? Obviously, this is little harder. Know both the things, okay? Now, this will be dealt according to IFRS 9, by the way. It's a financial liability. Okay, but right of use asset and lease liability, normal lease accounting. Coming to ceramic, C. C will debit machine, will debit financial asset because for him it's a financial asset, and will credit cash because he has to pay cash. How much will be the machine? 2.8, the fair value of the machine. And here financial asset will be 0.2, the excess, and 3 million is the cash. Okay, now they have given you the payment also. So the payment and the receipt will be allocated between the lease and the additional finance. Okay, this is based on the proportion of the total present value that they represent. So you see 1.7 is for lease, 1.9 is including that 0.2 additional financing into 500,000, because this was annual payment. Okay, the present value they were given. So it will be 447,368. Okay, this is allocated to lease. Why? Because check the numerator. Now for additional finance, it will be 0.2 over 1.9 into 500,000. Why 500,000? Again, in case you forgot, just check. You want to know this annual payment. They have just given you one figure, annual payment, but you want to know how much of it goes for lease and how much of it goes for additional finance. Okay, so out of 0.2 we know is for additional finance out of this total 1.9. That's why. Okay, now it will be 52,632. This goes for additional financing, AF. This is how you have to do questions if additional financing is given. So that's it for IFRS 16. Now let's summarize what we have discussed. We have started with identifying a lease in the contract. That means a right to use an asset for a certain period of time and you are paying a consideration for using it. Okay, that is the meaning of a lease. Sometimes in a contract there could be a lease component or a non-lease component. Okay, leasee accounting. Leasee means you recognize right of use asset and lease liability. Okay, unless there's an exception. Lease is for short term, that is 12 months or less than that, or of a low value, like for phones or your tablets or PC, like that. Lessor accounting is classified between operating and finance lease. There is a 5 or 6 points for finance lease. Go through the list. And sale and lease back. You have to determine whether transfer qualifies as a sale. If it's a sale, what applies? If it's not a sale, what things do? So that's it for IFRS 16. IFRS 16 is little, it has tricky areas. So you need to do this more and more often. Okay. But once you keep on doing it, you will get the hang of it. Until you are not very confident, I would advise you to do it several more times compared to other standards. See, some standards are more tricky than other standards. Like IFRS 16 is one, IFRS 9, then we have income tax, IS 12, then we have some standards are there, okay, which are a little challenging. So I would advise you to focus on those standards more than the time that you spend for normal easy standards like IS 16 or IFRS 15. These are easy standards. Okay, so anyway, see you in the next lecture. Till then, take care and thank you for watching.